Enron, the biggest financial fraud in Wall Street history. The saying, the bigger they are, the harder they fall, seems to be a perfect description of what became of one of America's best performing Wall Street companies. This was a company that rose to dizzying heights before plummeting dramatically. Once regarded as a revolutionary corporate giant, it turned out that there was more to Enron than meets the eye. Little did the public know that one of the largest companies in Wall Street history was sitting on perhaps the biggest scandal America had ever seen. This scandal alone was responsible for thousands of lost jobs, numerous convictions, billions of dollars stolen, and even one suicide. So what exactly was Enron involved in that shook the very foundation of Wall Street? Well, we'll have to start at the beginning. Enron was created in 1986 after a merger between Houston natural gas firm and Omaha-based InterNorth Incorporated. Enron was responsible for providing a variety of energy and utility services around the world. At the helm of the affairs was Kenneth Lay, who was the former CEO of Houston Natural Gas. Kenneth Lay was born to a Baptist preacher in Texas. At a young age, his family was plunged below the poverty line after the family's general store had failed. From a tender age, Lay understood the bitter side of being poor and hoped one day to escape the shackles of poverty and make something of himself. This was the case for him, as he graduated from the University of Missouri with a Bachelor of Arts in 1964, where he majored in economics and got a Master of Arts in 1965 after attending David H. Hickman High School. He joined the U.S. Navy, where between 1968 and 1971, he attained the rank of lieutenant. He also started his journey into the corporate world while making influential friends like George Bush on the way. He became the CEO of Houston Natural Gas and changed the name to Enron in 1985. After Lay became the CEO of Enron, he quickly rebranded the company into an energy trader and supplier. Over the next few years, Enron rose to prominence when Lay assembled a team of executives capable of concealing billions of dollars in debt from failed deals and projects. They utilized accounting loopholes, special purpose entities, and poor financial reporting to achieve this. However, it didn't take too long for things to go south. Two Lay's traders were caught by auditors moving money into their own accounts. Both traders were later convicted, with one of them ending up behind bars. Unsurprisingly, Lay pretended he had no idea about this, while inferring that both traders were working on their own volition. But with one of his big-time moneymakers behind bars, Lay had to devise a plan, and fast. Lay established the Enron Finance Corporation in 1990 and appointed Jeffrey Skilling as his CEO. Jeffrey Skilling, who was one of McKinsey's youngest partners at the time, had earlier impressed Lay with his work as a consultant for McKinsey & Company. However, things didn't turn out the way Lay had expected. There were early signs of trouble when, in February 2001, Jeffrey Skilling replaced Lay as CEO. But only 6 months after, Skilling stepped down as CEO, with Lay taking over again. Skilling was meant to be the company's ticket to making unlimited amounts of money. And to his credit, he made a conscious effort to achieve this. First, in order to increase financial earnings on the books, he came up with the idea for mark-to-market accounting, which allowed the corporation to declare income from projects even if the firm might not have received the money. Investors frequently received incorrect or misleading reports because the company was continually recording profits that it didn't actually make. This led to significant gaps between stated profits and cash. Amazing, huh? This made the company seem worth way more than they actually were. But Skilling had more up his sleeve. He came up with a grading system for the employees, and when they didn't meet up to the standard, they were fired. This kept all the employees constantly on their toes, with some employees even working over 18 hours a day. Additionally, Skilling steadily altered the company's culture to promote aggressive trading. He built a fiercely competitive climate within the company where the emphasis shifted to closing as many cash-generating trades as possible in the quickest amount of time. He hired top prospects from MBA programs across the nation to achieve this. Andrew Fastow, who quickly advanced through the company's ranks to become Enron's CFO, was one of his most brilliant hires. Fastow supervised the company's funding through investments in ever more complicated products, and Skilling was in charge of expanding its sizable trading activity. Lay made a $2 million profit on the sale of 93,000 shares of Enron stock, while still telling employees via email to keep purchasing the stock and forecasting significantly higher share prices. Ultimately, it was discovered that Lay had sold more than 350,000 Enron shares for a total gain of more than $20 million. But it soon came crashing down. Enron took an even more significant step towards fraud by merging with Pacific Gas Electrical Company. The company had access to the California grid and was controlling electricity and power plants to increase profits during this time. They would move electricity out of state to increase demand, and when the price got high enough, they'd bring electricity back. The people of California were constantly experiencing blackouts and continuously protesting. At this point, investors started keeping a close eye on the company, and people began to question the company's morality. Around this time, Skyling abruptly resigned to protect himself from the consequences, and Lay was reinstated as CEO. By this time, Lay had received an anonymous message from Sharon Watkins, a vice president of Enron, who had expressed concern about the Fasto partnerships and warned of potential accounting scandals. As more people began to have doubts about Enron's business practices, the cat was gradually let out of the bag. The broadband section of Enron disclosed a staggering $137 million loss. In October, the CFO's legal counsel instructed auditors to destroy the files of Enron and asked to maintain only the utility or necessary information. Analysts lost interest in the firm, lowering their ratings for Enron's shares as a result. In response, the corporation's stock price plummeted to $39.95, a 52-week low. Investors started to question the company, while Lay tried to put up a calm front, but at this point, SEC had already begun to launch an investigation into the company. On October 22nd, the Securities and Exchange Commission opened an investigation into the company. With the release of this information, Enron's stock continued to decline and was recorded at $20.75. The company first acknowledged and disclosed that it had overstated its income levels by $586 million in November 2001. Furthermore, it had been doing so since 1997. When the company declared bankruptcy on December 2, 2001, the share price remained unchanged at 26 cents. Employees lost several perks and pension benefits as a result of the bankruptcy. Many people found themselves on the verge of a financial crisis. The crisis was so severe that business shareholders lost an estimated $74 billion in value. After emerging from bankruptcy in 2004, the new board of directors filed a lawsuit against 11 financial institutions for their part in helping to cover up the fraudulent business practices of Enron executives. Kenneth Lay pleaded not guilty to all 11 criminal charges leveled against him. He was sentenced to up to 45 years in prison after being found guilty on 6 counts of securities and wire fraud. But Lay passed away on July 5, 2006, before he was sentenced. Jeff Skyling was found guilty on 19 of the 28 counts of securities fraud and other insider trading charges. The United States Department of Justice negotiated a deal with Skyling in 2013 that resulted in 10 years being taken off his sentence, which was originally 24 years and 4 months. The collapse of Enron and the financial devastation it caused to shareholders and employees prompted new regulations and legislation to promote the accuracy of financial reporting for publicly traded companies. The Sarbanes-Oxley Act was signed into law by then-President George W. Bush in July 2002. The act increased penalties for destroying, altering, or fabricating financial statements and attempting to defraud shareholders. Enron no longer exists. It sold its last business, Prisma Energy, in 2006.